Hello guys, how you doing, man? Hope everyone is great. Hope everyone's having a good day, and welcome back to one of the new trading modules that I'm doing for you guys today. Now, this is going to be for the more advanced members, and I don't expect everyone to do this. But once you guys have understood the process, and once you've gone a few sessions and you understand how everything works, and you feel really confident in the method that I'm teaching you guys, this is something that you can, really do to maximize and get a bit further than you are right now. All right, so this is the maximized amount of risk to reward you can get, and you can use this alongside our normals, London Open strategy technique. In fact, this strategy is going to be based on the London Open technique, and based on the breaker setup that we use, right? So I want to just give you a bit of a background, to this technique and where it's going to come from. Now, this is something I've known about for a while. I haven't really been using it because I haven't found the right conditions to use it in. Now, what I'm going to be showing you guys today is what are the best conditions to use this technique in, when to look for it, and some staple rules which you can use to make sure that it is profitable for you in the long run. Now, I want you guys to realize that, like any other strategy, you guys should back test this yourself. Don't just take my word for it. Everything I want you guys, everything I show you guys, you won't be able to do it in real time because you won't have the confidence to do it. And the only way you guys are going to get the confidence in using this strategy, especially because it's very, very nimble and you have to be very nimble to use it. The only way for you guys to really get the confidence in it is to back test it thoroughly and then to go and take the plunge and then, trying a demo account and then trying a live account. That's the process I want you guys to take with this, because this will rocket your risk reward, and it really is a game changer when it comes to trading with order flow, trading liquidity and trading brokers, right? But it isn't something I want you guys just to rush into the market with and just try out live straight away, because you need to have discipline when using this technique like any other, and you need to be in the right state of mind to use it. And the only way you can do that, guys, is by doing the hard work on the back end. Okay, so now we've got that shit out of the way, I wanted to run you guys through it now. I've done, as you can see, I've done a bit of back testing today on it just to see when are the best times to use it. Now, essentially with the strategy, guys, there's three main points to it. Okay, now, this isn't a different strategy to what we're using. We're just using a different time frame with the same strategy. So it's the same breaker strategy, guys, where you're looking for, as usual, which would be an expansion in London Open, neutralizing liquidity above that structure high or the previous day structure high or structure low, depending on what you're looking at. And then obviously you pull back down inside of the range and targeting liquidity at some point inside of the range, whether it's a void here, whether it's a previous day's low, whatever it is, right? So I would just want you guys to understand that we're not doing anything, completely structurally different. All we're doing is we're looking for the same strategy or the same entry requirement, except we are scaling down the time frame again. Now, I want you guys to pick up on what I'm doing here. Now, you guys know I don't do anything different, and I make a big point on refining things rather than learning new things, and this is all we are doing with this strategy. Okay, it's the same breaker strategy we would usually use on a 5-minute time frame, or a 15-minute, or a 30-minute, or hourly time frame, even a 4-hour in a weekly. But the only difference is that we are using this on a 1-minute chart, and therefore the way we use it and the rules that we are going to be using it with are going to be a bit different to how it would be on a 50-minute chart. All right. Now, essentially, guys, let me just walk you through what it is, and I'll break down all the strategies and break down the way you should be using it a bit later on. So, as you guys can see here, we have a structure high, right? We have the previous day's structure high right here, and we have the new day neutralizing liquidity above that structure high, right? So, when you guys have to realize, look, this is the same thing we usually look for. So, as you guys know, when I'm bearish in the market or when price has taken out a significant range high, which for me is either going to be a previous day's high or a previous day's or a previous week's high or low, then I look for price to pull back inside of the range, and I look to trade it deep inside of the range, target obvious areas of liquidity, which in this situation would be, this low that we have here, and also this void area that we have here too, right? So these are very obvious areas of liquidity that I'll be targeting if I was to trade price back into this range. And as you can see, that is what happened the week before last, right? We've got expansion above there, neutralizing liquidity. We've got a false break in the market, and we've got a pullback inside of this range. Now, this strategy, guys, as you guys know, the breaker strategy is to get in on this retracement or this pullback as close to the structure high as we can, okay? This is the most, I think this is what I want you guys to realize, and I want you to understand what is really going on here, okay? The reason why we use breakers, right, in this type of strategy is because we want to be selling or buying, depending on where it is, but let's say in this situation we're selling, right? We want to be selling price as close to the high of the day as possible. So when you are intraday trading, what you want to be doing is you want to be selling as close as you can to the high of the day, and you want to be buying as close as you can to the low of the day. Okay, that is the main strategy. And the reason for that is because, as you guys know, I want to run through this real quick. When you have a candle, you have the open, like that, right? You've got the open right here. Then you have, let's say it's a sell week, right? Then you have the expansion above the market, right? Then what you also have is you have the distribution, and then you'll have the close, right? So this is what the average daily, weekly candle will look like, right? So our purpose, guys, what we want to be doing is we want to be getting in as close to the extreme of the range as we can. Okay, so if we're looking to sell, we want to be selling anywhere above the open, and that's the same strategy we're using here, guys. Okay, so we want to be selling as close as we can to that opening price, and we want to be holding it as long as we can for the distribution. And obviously, depending on where you take your profits inside of this distribution phase, will depend on where are the liquidity points of the distribution. Now, I want you guys to look at this candle formation as a range. That's all it is, okay? This is how a weekly or daily candle is, but all it is a range. This is the high of the range. This is the low of the range. These are the two entry and exit points inside of that range that you want to be aiming for. That's all you are looking at. So when you're looking at a daily candle, and let's say we go into a bar graph, which I'll do in a minute, essentially all it's showing you is it's just showing you that day's range. Okay? And that's what I'm saying, guys. The range is the most important part of whatever we are doing. It's what facilitates trades. It's what, gives us our entries, our exits, our targets. Everything is consistent around the high, the low, the open, and the close. That is what trading is about in terms of technical analysis, right? So it's the same thing we're doing here, guys. Okay, what we're essentially doing is that we're waiting for price to get above today's high. This is the power 3 concept. I'm not going to go into too much detail, but that's the opening price and midnight. On sell days, we want to see price get above that. Now, this move up here was a protraction. It was an impulse leg up. And what was it doing? It was taking the previous day's high. So this, essentially, guys, is this movement here, okay? That protraction upwards is that expansion above the open, which the open is right here. So this day's candle will look a little bit like this, right? Where we have an expansion up, drop below, and then a close right here. That is what you're seeing here. You're seeing the opening price, which is there. You're seeing that leg up, which is this manipulation phase right here. All this is a manipulation. Why? Because it's getting people to buy when they should actually be looking for shorts. And the trigger is when this previous day's high is taken out. And that is when we start to look for sales, okay? So the trigger is the most important part. This is what lets you know when you should start expecting price to reverse in the true direction it's going to be reversing in, which is what you see here, a nice big distribution from the opening to the close. Now, the purpose of this video, guys, is to show you how to get an entry as close to this high as you possibly can while still managing your risk, while still following structure and being smart about what you're doing, okay? And that's all we do. Now, guys, what would you rather? Would you rather sell around this point and ride it down? Or would you rather sell at that point and also ride all the way down? Now, what is going to give you a better risk to reward? This position here or that position down there? Obviously, it's going to be this up there. So our aim with this, guys, is to be selling as close to this high as we can. We don't want to be trying to sell the actual high, guys. I'm not saying that's what we should do, but we are really pushing the boundaries here to how close we can get in at the high, and we're really kind of pushing the boat out. Now, this is why I'm telling you guys to only trade this in a particular market, because you don't want to be trading this. You don't want to be trading this ship at any given higher range, higher range low. You want to be trading this when you have the best conditions to give you the best chance of this working out. Now, it's not always going to work out. A lot of the time, you will get stopped out. I'm going to just be real. I'm going to be real with you guys, but that is why you must follow the rules I'm going to give you, throughout this video to make this be successful for you. Now, as you guys know, usually, let's say I was expecting a distribution down after we had this previous day's high taken out. Usually, I'll be getting in at this at the 5 minute block, right? and then I'll be riding it all the way down. That will give you, you know, a really good risk to reward, guys. I'm not gonna lie to you. This would, let's say we're being a bit more conservative, right? If you held that throughout the entire day, let's see where that was lining up to. All right, let's just see where that was lining up to real quick. So if you held that to the previous day's low, that would have given you almost an 11R, which is amazing. I mean, from one day's work with only one position, that's brilliant. I mean, you've got like your whole week done in one trade, right? That's amazing. However, you know, we can still do better, guys, and that's what I'm saying. I'm always here. I mean, I'm not saying that you should be doing this all the time, but you know, our point here is to get better at what we're doing, to always improve what we're doing, to become the best traders that we can. You know, both psychologically and technically. So, what I've been doing some research on is how can I get a better entry up here? What can I do to, you know, give myself the best chance of making the most of my while still minimizing my risk, guys? And this is what I'm trying to say. This is the reason we are going to these extents, because we don't want to be risking more than we need to be on a trade. We want to be risking the same and getting the most out of it. So risk the least amount to get the most amount possible. That is the aim of the game, and that is the kind of methodology I'm trying to communicate to you guys, right? So what we can do here, guys, is instead of sitting at that 5-minute block, what can we do? We can scale down again and we can go on the 1-minute chart, and this is how we can get an even tighter entry. Okay, guys, now I want you guys to take this with a pinch of salt, right? I'm not saying you should always be looking for 3 pip stops, okay? And I want you guys to really understand this. And this isn't something I use all the time. In fact, I rarely use it. I'm only going to start using it a lot more next year, because I've been doing more work on it. But I want you guys to realize you do not have to, you shouldn't be using this all the time. This strategy, guys, is for special occasions when everything lines up, and we'll talk about that a bit more, guys. But for now, let's just run through what I'm actually showing to you guys. Now, this was actually the previous day's high right here. So let's just mod out. So this was the previous day's high. This was the weekly open, or the daily open, sorry, right here. Okay. Daily open. So we've got a previous day's high right here. We've got the daily open right here as well. All right. So we've got 2 levels of support resistance, whatever you want to call it, 2 significant levels being taken out now. So once we see this, guys, once price starts to break down, this is when we want to start looking for sales, okay? Once price has neutralized liquidity above that high, okay, then we want to start waiting for a breakdown in price. Now, what I have found, guys, is that usually the best way to use this strategy, right, is to wait for price to break down twice. Now, obviously here, this was a beautiful example of how you could have got an entry based off, the first break. But as you guys know, the tick charts are not that reliable. The structure shouldn't be taken that, like the gospel on the tick chart. Why? Because, the structure of the tick chart will break as much as price moves, as we all know. And that's why I'm saying, guys, you want to be using this in the best condition when there is the most selling or buying pressure in the market at a given time. That's when you want to be using this technique, right? You don't want to be using this in counter trend trades. Do not do that. You will only end up fucking yourself several times. Don't bother with that. Only be using this strategy when price is literally trending in this direction and when this movement up is just a retracement, okay? This impulse leg is just it's more or less what it is, guys. It's a retraction, it's an impulse in price, it's a retracement. That's all this is, okay? So treat it as a retracement. This is order flow. This is the selling pressure that we are looking for in price. So when you see price do this, guys, you only want to be looking for this setup when you're in line with order flow, when you're in line with the daily order flow of that day, the intraday order flow, when you're in line with the weekly and the monthly order flow. This is the only time I'll use this technique, okay? I will not use it on short-term retracements intraday. I will only use it, right? I'll only use it in terms of the power 3 concept, only when we get either a daily high or a weekly high taken out and it's in line with order flow, okay? So let's say price was bearish, which it was for the past couple of days, past weeks. This whole move was a retracement. So once I saw price breaking down, I had the confidence to short this, right? Well, because I actually got an entry here, guys. I had the confidence to short this because I knew that this was a retracement. I knew that there was a significant level of stops that I was just taking out right here. And I knew that price was bearish long term. So when price started to break down, this was a real breakdown in price that we just saw here. Okay, this is not a retracement. This is price actually following order flow, and I want you guys to really understand what I'm doing here. Okay, so again, guys, all we are doing here is we are waiting for price to break down below a 1 minute breaker, like that, and then what we want to do is put our stop. Usually, what I'll do is I'll put my stop double the distance. So if I'm shorting it here, I want to literally measure that out. I want to measure out the breaker, and then I want to double it like that, and that is where I put my stop, right? So there's two ways you can do this. Either measure out the breaker, and then you want to flip it again, double it, and you want to put your stop above there, or what you can just do is just put your stop above the next structure high, which will be here. Okay, you've got two options right there. Okay, obviously in this situation, once price actually broke and closed below here, I'm not counting this candle because this candle was a closing candle, right? Once price closed below there, it never got back up there. Okay, this doesn't always happen. A lot of the time you get price break below, then they'll go and whipsaw up and break down again and then break down. But in this situation, this is like a perfect trade, guys. So essentially, guys, what you're looking for is you want to just basically short price from a 1 minute breaker and put your stop above the next structure high, or above, or more or less just double whatever that breaker was. So measure the distance from the breaker and put it double. So let's say you're putting your entry, your stop loss up there, and your entry was literally right here. I want you guys to understand what the risk to reward is on this. So let's say, you were targeting the previous day's low right here. That's basically almost a 18R. Let's just call it an 18R, guys, all right? That's almost an 18R trade that you've got there. So you've almost doubled what you would have made on the initial 5 minute breaker, which is more than like a 10, 11R, right? You've almost doubled that with an entry closer to the high, with less risk, and you would still have the same target. So do you guys see how you can really get monumental gains from this now? Right? And then obviously, guys, the great thing about this as well is that once price breaks below here, the chance, because you sold so high near the wick, guys, there is no fucking chance price is going to get back up there usually. If you've done your research properly and you're trading in line with order flow, and you've waited for previous day's high, previous day's low to get taken out, there is the chance price is going to get back up there and whip that out. It's extremely low. So the whole point of doing this, guys, is because you want to make sure you want the lowest risk setup for the highest gain. This is the lowest risk because your position is so unlikely to get taken out. There has to be a monument. Look, once price breaks below here and breaks below this level there has to be like a news event to take price up there and wick it out, and that can happen, guys. That does happen, but the statistical probability of that happening to how often you be using this strategy is extremely low. And if you follow this in line with the conditions that I just sent you, you want the daily and a weekly and a monthly order flow to be in line with each other. You want price to take out a significant area of stop, so either the previous day's high or the previous day's week's high or low, and it's in line with that order flow, then you should be fine taking these kind of setups, okay? So I want you guys just to realize this is what we're doing. We're more or less just taking the entry off a 1 minute chart. And then the brilliant thing about this, guys, is that once price, you can still get that 15-minute block entry or the 5 minute block entry. Let's go into the 5, right? After price has done that and it's broken down here, you can just short it again. And the great thing now, right? The great thing now is that you can move the stops. This is a risk-free trade, guys. Like, you can move your stops to break even so quickly on this trade after it breaks this level, because the chance of price getting back up there is extremely low once it breaks structure on a 50 minute or a 5 minute. Okay, it's extremely low. So there is no reason for price to be reaching back up there again. Obviously, if price finds support here and it whipsaws you out, then obviously that's peak. But the point I'm trying to make, guys, is that you can make this risk free extremely quickly. Okay, you're either going to be right or wrong, because price is either going to break through that 5 minute breaker or it's not. There's no bottom line, right? But the point I'm trying to make, guys, is that you can move your stops to break even as soon as price reaches that breaker. As soon as price reaches that breaker, move your stops to break even, right? Because price is either going to just whipsaw back up, maybe tick off that breaker, off that block, and then break down, or it's just going to break through it, right? But usually, if price is in that order flow, it's not going to hold at that first breaker, or at least it's not going to hold at at the breaker that pushed price higher to neutralize liquidity. It's not going to do that. So usually price will just break through, which means you can neutralize that position extremely quickly. You can make it risk-free extremely quickly, and you can be up a lot in a very short space of time. All right, I mean, very, very short space. You can be 5R up, 6R up, just to take out the Asian lows. Okay, so this is what we're doing now, guys. Okay, we're just more or less seeing what works, and then we're making it a lot better. Sorry about the notifications, guys. Okay. So again, guys, I want you just to understand what we're doing here and how this is working. Now, I'm going to show you another example of this. Christ, this is ridiculous. All right, guys. So again, we have another example of it again last week or the week before last when price was retracing all the way up here. So what we saw here, guys, was we saw price. Wow, this is ridiculous. So what did price do again, guys? As we already knew from this week, it was extremely bearish, right? So price was extremely bearish. It taken out a previous day's high. I think that was a weekly high as well. It taken out almost a weekly high over there, right? So price made the high the week on Tuesday. Now, where was it reaching? Where was price reaching for, guys? Price was actually reaching for this liquidity point right here. So the point I'm trying to make to you guys is that, look, you could have got an entry at the high of the week, and let's say you held it down to this significant low, to this significant low. What do you think the risk to reward in that would be? In fact, let's actually measure this shit out. Okay, let's just put it there like that, right? Let's say your entry was there. Let's say your stop was there. That's a 20R. In fact, am I doing that shit right? Yeah. So that's a 20R down to here, right? That's a 20R down to, Friday's liquidity block or Friday's block, right? Let's say you held that trade down again. You made 40R, guys. Let's just measure that shit real quick. You made almost 40R if you hold price down to this level right here. Let's just call it like a 36R. That's 35R you made by holding it for the full weekly range of one position. So that's 35% you've made if you're risking 1%. For some of you, that's your whole monthly target done, right? Or for a lot of you, that's your whole monthly target done. So you can see how this technique is extremely powerful when you start swinging it and using it with swing positions. Now, as you guys know, I am a day trader. I don't swing these positions, but what I do believe in is I do believe you can swing in terms of the weekly bias. You can trade the whole weekly bias. Now, if the weekly bias is short, guys, then you can hold. I would hold this position for the whole week. Why? Because I know the bias for that week is short. If Tuesday or Wednesday makes the high of the week, guys, usually the bias will be short as long as it lines up with what the higher time frame is doing. And that is more or less what happened here. We had Monday, Tuesday, Thursday, Wednesday, Thursday, and then Friday. We saw an expansion down to that low. So, guys, the minimum you'd have made for this if you held it for the whole weekly bias, right? Let's say you were just holding it down there, it's 20R. That's 20% you'd have made with 1% risk, right? From one position. That's not taking into consideration the position I'm going to talk about here and the position I'm going to be talking about, or the position that you could have added on at that 15-minute breaker right there, or again. And do you know what I'm saying, guys? Like if you were short this whole week and you had a position there and a position there, you'd have been up almost 35R, 40R for the whole week from one or two positions. So this is extremely powerful, guys. Okay. So again, I want to show you guys what this looks like on another day. So again, what do we have here, guys? Price was bearish. The weekly bias was bearish. What did we have? We had an impulse leg up. In other words, we had the Judas swing up to take out a previous day's liquidity right there, or previous day's high, sorry. And then what did we get? We got a breakdown back inside of the range. And I think you guys remember me talking about this trade, right? I was actually short here, but I got stopped out. Because it was Thanksgiving, guys, we didn't get the distribution until Friday, which was really silly of me because I actually had a position up here and I closed it out because I wasn't paying attention. But that's besides the point, guys. The point is that if you got an entry up here again, and let's go through this again, you would have a great opportunity to go short. Now, I want you guys to realize, again, this is why sometimes I say, guys, it's better to wait for the second break. Now, if you were waiting for the first break and you shorted straight away from here, as soon as price broke that, I mean, at the same time, guys, if you put your stop above the breaker, you'd be all right. But as you can see, price broke down, pulled back in, then a breakdown again, then we saw the a breakdown again. But again, guys, breaker, 1 minute breaker, short from there. You put oops, see there's it. Cancel that. So you put your stop above the breaker, where your target's going to be again. Let's have a look. Your targets are going to be at that block right there. So again, guys, if you held that position and that position for the whole weekly buys to take out even that day's lower or come down to this fill in that range, 20R plus 18R, 38R from 2 1 minute entries, guys. 38R, and that's not even talking about the initial, our real positions, which are going to be like our 5 minute breakers, our 15 minute breakers, to then go short back into the range. Okay, guys? So this is extremely powerful, and I would say, back test this before you use it. But you want to be using this when price is actually trending in one direction, when order flow is, in the same direction you're trading that day, when the intraday order flow is also in the same direction, right? And when price is neutralized the liquidity point, okay? And this is extremely important. There has to be a previous day's high or previous day's low or previous week's high or previous week's low neutralized. Do not use this position, for example, when you're trading a retracement, okay? You will not get the same results. There's a much higher chance you'll get stopped out, and you'll just spend a lot of time trying to go short here, wasting 1, 2, 3% of your account when you could have just waited for a 15-minute breakdown, okay? So only use these positions, only use this strategy, guys, when price is literally trending in line with order flow and when it's taken out a significant liquidity point, okay? And that is the best time to use it, guys. But again, there is so much potential in this. There's so much opportunity with this. You've got to just back test it, see what works for you, and let me know, guys, okay? But this is the end of this training video. I wanted just to show you guys real quick what I was doing and how to supercharge your results and how to literally, because you can swing a position with this, guys. You can use this as a swing entry, okay? And you don't have to do this on fiber, guys. I mean, if you're trading for example, dollar yen, you just wait for a previous day's low to get taken out, then you can trade right back up into the range, okay? Right back up into it. Let's go into a 4-hour chart, guys, real quick and just show you. So this would have been a brilliant example right here, okay? So price had taken out this 4-hour high right here. Where did it come into? It came into a block. So stops taken out into a block. What day was this? This was 7th of November, right? So 7th of November, right? What do we get? So here was the entry, guys. Boom. Significant high taken out. Let's see if there was a 1 minute entry. Okay. Let's see if there was a 1 minute entry for this. So, did we get a double? Did we get another break step? All right. So look. So what happened there? We got a double takeout. Okay, guys. Now this one to say sometimes the strategy won't always work. Sometimes, let's say you try to short it from here, right? So let's say there was a small breaker there. You short it from there, put your stop above that level. Sometimes price will go up again and it wick you out. That's what I'm saying, guys. You want to be making sure you use this in line with order flow and really waiting for a breakdown. And I'm not gonna lie to you guys. Sometimes this won't work, but when it does work and when you do get in line with order flow, when you do have the right conditions, this is insane. So let's say price, because I think this happened on the 5 minute, right? We got so on the 5 minute we got price initially going take the high. Then what did it do? Meandered down below that breaker, then it went back up, took it out and neutralized it, and then we got price stay below this 5 minute breaker and then distribute, and then we saw a massive distribution for the rest of the week. So let's say we wanted to get an entry on the 1 minute chart. The best entry here, guys, probably would have been once price neutralized that high again, okay? So once it neutralized that high again and it started to break down, there was one entry right here. There was also another entry right here. Okay. Boom, right here. And probably this would have been the one I would have taken, right? Because it's it's the second breakdown. Here was the first breakdown, price breakdown, formed a little block there, and then break down below that block. But here was the best breakdown. I think this would be. That's why, guys, I say sometimes it's better to wait for the second breakdown because it gives you the confirmation you need, and you're still going to get a decent risk reward as well. Okay. I mean, if you held this for for the whole day, right? To this day's low. I mean, that's more than 20R just to this single day's low. We're not even talking about, guys, the rest of this move. I mean, look at that. Look at that, guys. If you held that right, let's say you go an entry up here and you held that right down to this, to October's low. Okay, this is October's low, right? What would the R have been on that? Let's see, 97. That would have been more than 40R, 41, 42R, guys. All right, and this would have taken you like 1 week. Again, 1% risk on this, guys. What is that going to amount to? That's going to amount to 40% of your account. 2% is going to be 80% of your account. Imagine doing 80% of your account, guys, in a week. This is what I'm saying. It's less, not more. Okay, it's all about doing less and trying to get the maximum results out from whatever you're doing. Okay, guys, so I hope you guys enjoy this video. I hope if you guys have any questions about this, which I'm sure you guys will, shoot me some questions and I'll try and help you the best I can. But study it, guys. Just study it, do the back testing, demo trade it for a minute, and then get to making this money, man. All right, see you guys.